Thanks so much for having our paper. It's great to see you all, even though it's virtual. This paper is titled How Competitive is the Stock Market? It is joint work with Paul Huebner, who's a fantastic grad student at UCLA, and Erik Loualiche from Minnesota. And they're both here today, actually, so they would be really happy to take your question in the chat, and we very much look forward to your feedback. So let me tell you what got us started on this paper. There are many important questions in finance that are about figuring out the effect of a change in the trading strategy of some institutions on equilibrium asset prices. One such big question, which we will talk about today, are the consequences of the rise of passive investing. Say a fraction of the population of institutions becomes passive, what happens to equilibrium prices? And the most standard answer to this type of question in the finance literature is simply that nothing happens. The justification for this answer is that financial markets are very competitive. So these local changes will somehow fix themselves in equilibrium. If you dig a little bit more, the idea is that the direct effect of the change in strategy, the yellow arrow here, is counteracted by the fact that other investors change their strategies as well in response to that. In the case of passive investing, this would be the remainder of investors trading more actively. Another more fun example is the case of arbitrage. If somebody stops looking for $20 bills on the floor, it's not a big deal because somebody else will do it instead. What the views that markets are very competitive tells you is that these equilibrium responses are very strong, actually so strong that they exactly compensate the direct effect. In this paper, we want to ask how large the competitive response actually is relative to the direct effect. And once you have a number for this relative intensity, we can plug it in and plug in the rise of passive investing and ask what are its implications for prices. And as a remark, for today, we will focus on passive investing, but I want to point out upfront that these equilibrium responses matter for other interesting questions. Another such question that's been the focus of a lot of my research is what happens when intermediaries get distressed or start facing different regulation and trade more conservatively. You could also think about what happens when an arbitrager, think a hedge fund like Melvin Capital, goes bust. The first thing we do is to formalize the notion of investor competition of equilibrium response. One insight is that while there are many reasons why investors change their trading strategies, these changes can be summarized by a choice of demand elasticity in many theories. Said otherwise, at the end of the day, what matters is how aggressively you trade against price movements. From there, we propose a simple sufficient statistic for the strength of equilibrium responses, which we call competition chi. It is the answer to how much does my demand elasticity respond to a change in the aggregate demand elasticity. In my arbitrage analogy, it is asking if I hear that there's one less person looking for $20 bills on the floor, how much harder do I look? One big disclaimer I want to make is that this notion of competition is mostly unrelated to the more mainstream economics notion of being a price taker or not. Rather, we follow the classic finance saying and relating it to the strength of equilibrium response, or what people sometimes call strategic substitutability in trading. Building on this notion, we put forward a framework to quantify competition and its implication for prices. By this, I mean a model you can estimate from data on how people trade. This takes the form of a demand system, which accounts for investor heterogeneity, but also for equilibrium relations. The novel aspect of our model is that it takes the form of what we call a two-layer equilibrium. Naturally, prices adjust so that the market for each asset clears, but a new part is the second layer of how investors choose their strategies in response to others. In particular, how investors choose their demand elasticities in response to the aggregate. We show a tractable way to deal with this structure, in particular, how to use it empirically to identify the level of competition. Finally, and maybe most importantly, we take this model to the data. We use data on portfolios in the US stock market from 13F filings, and we find that competition is far from perfect, with Chi equal to 1.7. What that means is if you're a small trader and the aggregate elasticity in the market decreases by 1, you increase yours by 1.7. This is far from the idea of perfectly competitive market, which would be okay, closer to infinity. But this is still, and in particular at the individual level, a non-negligible strength of response. In equilibrium, what that leaves us is that competition dampens the effect of individual changes in behavior only by about half, by 50%. And if you apply this multiplier to the rise of passive investing that we can measure in the data, this predicts that the demand for individual stocks has become significantly more inelastic over the last 20 years by about 15%. For the rest of the talk, I want to first show you zoom in on the core of our framework, this notion of a two-layer equilibrium and this notion of competition. And then I'll tell you how we can take this idea to the data and what we learn about the evolution of the stock market from this exercise. So the first layer of our framework is extremely standard. It is the idea that each investor demands some amount of an asset. Here, I is an investor. DI is the amount she demands. Small letters are logs, big letters are level. And to make it simple, we assume that each investor's demand is just decreasing in the price with an elasticity EI. The demand elasticity is the answer to by how many percent do you increase the quantity of asset demanded in response to a 1% decrease in price. It measures how aggressively you trade against price movements. To go from individual decisions to a price, you need an equilibrium condition. The sum of demands is equal to the supply. Our model introduces competition through a second layer. It determines the demand elasticity. Here we assume that each investor's elasticity combines an individual effect, that's E bar I, and a response to other investors materialized by the aggregate demand elasticity. Intuitively, my own characteristics, how sophisticated I am, how risk averse, etc., determine my demand elasticity, but also who else I am trading with. Here again, because investors interact in an equilibrium condition, it is that the aggregate elasticity combines individual decisions. The key parameter in this model is competition chi. When chi is equal to 0, each investor lives their own life. If others become passive, well, good for them. You stay the course and trade in the same way. The other extreme is when chi goes to infinity. That's the full competition view. Here, anytime there's a change in behavior, other investors step in and counteract it in full force. A few investors become passive, while everybody else becomes more active to counteract that. Of course, and I will show you that that's actually what we find in the data. We live somewhere in the middle with some partial competition. And a number of theories can justify this case. For example, when a rational trader tries to profit from abnormal price movements, for example, caused by irrational traders, she does so less aggressively when she's surrounded by more other traders, and these other traders are more aggressive. Similarly, if others look harder for dollar bills on the floor, you're going to do it less. It also happens in theories of information acquisition. If others are more informed about prices, they are more aggressive, but then information becomes less valuable to you, and you become less aggressive. You could also have negative values of CAC, and then investor reactions would amplify each other. This happens in theories of liquidity, in the sale of CAL 89, or if you just get excited by talking to others on Reddit. Now we're completely aware that writing these equations like that is a little bit non-standard in finance, but it turns out that the mapping of the models I'm talking about to our framework is actually very, very tight. Unfortunately, I'm not going to have time to show you this connection in detail today, but it is in the paper, and the appendixes are growing actually fast with more and more applications, where we show how many classic models can be restated in this as this two-layer equilibrium. Our main use for this framework is to ask what happens in response to a rise in passive investing. To think about this, we start from a homogeneous group of investors, all with the same elasticity E0, and then the aggregate elasticity is the average, also E0. In the data, the last 20 years, I've seen a large increase in the quantity of passive investing, and that corresponds to reducing the fraction of active investors by about 30%. If there is no competition, it just means that going from the initial situation to a situation where 30% of investors simply do not respond to prices, and the remaining 70%, that's what I call alpha, is unchanged. Then the average elasticity simply becomes alpha times E0. We obtain a proportional reduction in elasticity. The market becomes much more inelastic. But with competition, things change because the remaining active investors will change their strategy as well. Because the market overall has become less elastic, they become more aggressive. This makes the aggregate increase back up, but this increase prompts again a second order response where the active investors decrease back down. That lowers the aggregate again, and you can keep going back and forth until this stabilizes to a new equilibrium. Adding up all those reactions, we obtain the new aggregate elasticity, which combines the direct effect in green and the total competitive response in red. The most extreme case is when competition is extremely strong and chi goes to infinity. Here you can see that this ratio goes to 1, and the competitive compensation brings the elasticity back to its initial level. That's very different from no competition. In that view, the rise of passive investing has no effect on the demand for stocks. The goal of the paper is not only to point out that it's important to understand that competition can be there, but actually to quantify it. So I'm going to show you in a few slides how we are able to estimate the parameter chi by using the cross-section of stocks and investors. And just to be clear, we're going to think about chi as a constant parameter, capturing the competitive structure of the market, and we'll feed through it the time series of the rise in passive investing. We estimate that chi is equal to 1.7. If I just plug into this formula, this implies that the aggregate elasticity has decreased by about 14%. That's a large number, in particular compared to the idea that nothing should happen. But that's also about only half of what you'd find if you just ignore the equilibrium forces. When I show you the framework we use for estimation, I'll redo this calculation, of course, in a richer way that accounts for investor heterogeneity. But it turns out the numbers are very similar. So let's move towards the data. So we want to take this framework with those two layers and quantify it. What's different, of course, in the data is that there are many stocks and many investors, and they're all very different from each other. So how do we do that? So we're going to get data on stocks, from CRISP and CompuStat. But what we're really interested in is how do people actually trade? So we're going to use the 13F filings to the SEC, where every institution that has assets under management over $100 million has to report their position to the SEC each quarter. That gets us to about 80% of the total ownership of the stock market in the 2000s. And the residual we'll just call as one last investor that we're going to call a household. Unfortunately, we don't have as nice data as Tarun showed us just before. And then we're going to enrich our model to take into account the fact that there's a lot of heterogeneity in the data and that investors choose among multiple stocks. And so we're going to build on an idea from a paper by Kojen and Yogo that says that you can represent portfolio choice with a logit specification of portfolio shares. So instead of simply writing the demand, you want to keep track of demand, so portfolio share relative to price, relative to a baseline demand. But after that, this is exactly our two-layer equilibrium. The demand for each stock is driven by some investor-specific function of characteristics. So each investor has specific taste for characteristics that we can measure. There's a residual that's unobservable to us as the econometrician that captures, how the investor might have some private signals about the asset or might just do some noise trading or different beliefs. And finally, there's a response to the price. That's what the elasticity shows up. Now, this elasticity, importantly in our model, is endogenous. It's not just a fixed number. It depends on the mapping between this investor and the characteristics. So we have investor-specific loading on characteristics. And it depends on the response to other investors. In particular, this response is a response to the aggregate elasticity for these specific stocks. So what that means is that each individual investor is going to be more or less aggressive in trading against prices as a function of what's the average elasticity of trader for this stock. This model actually embeds the model from Kojen and Yogo. In their framework, there's just no competition. So it's equivalent to assuming that this chi is equal to 0. Finally, for the data, it's going to be very important to separate out passive investors. And we're just going to do a first round of using the Kojen Yogo elasticity and split out anybody who seems to not respond to prices. So mechanically, that's going to pick up every formal index investor. That's a slightly larger notion that incorporates anybody who just doesn't respond to prices. Then, of course, we have our two-layer of equilibrium. So the prices have to clear asset demands, and the aggregate elasticity has to aggregate individual decisions. Now, this is a nice structure. It's very rich. The question, of course, is how can you identify it? In particular, how can you measure competition? And there are 3 challenges for that. The first one is a reflection problem that happens in any situation with social interaction. The second one is that it's hard to estimate demand. There's always some endogeneity floating around. And the last one is to take this to the computer. So in the interest of time, I'm going to speak mostly about the first one, and I'll just sketch out what we do for the others. So the reflection problem is very important. So is this the following idea? Let's say I see that Ralph is trading GameStop very aggressively. I'm sure that's what he's been doing actually the last few days. And so here you have a natural question that is it that he's on his own a very aggressive trader? Or is it that he just hangs out with Jonathan on Econ Twitter and he got convinced that GameStop is super exciting? That's what we're trying to separate out at the end of the day. And the simple insight that we use to go over this problem is that there are many stocks. And Ralph is trading in many stocks. So not only is he excited about GameStop, but he's also trading Tesla. And when he's trading Tesla, he's going to face different investors and might have a different aggressivity. And so just by comparing how Ralph trades when he's facing different investors, we can figure out what are his own characteristics and what are his response to other investors. Of course, there's a little bit of chicken and egg problem. That is, well, I'm using this to learn something about Ralph, but I already have to know something about the other investors. And so everybody's connected and you have to solve everything at the same time. It turns out we show actually in the paper that you can use the network structure of investor, and as long as the network structure of investor stock is this graph is connected and is not degenerate in a specific way, you obtain identification. So you can actually solve this chicken and egg problem. And what's nice for us is that the data, as actually Tarun showed us a little bit before, but actually even more so for institution, is very much like that. We have a lot of variation in who is trading which stock. And for example, the median number of stocks that's held by the investor in our data is only about 81. So you're going to get very different population for very different stocks. You're going to be able to separate out this competition effect. Stepping back a little bit, there's still this issue of this unobserved residual. That is, there's some endogenous variation in the regression. In particular, the price, but here as well, the aggregate elasticity are both equilibrium outcomes. So of course, they're endogenous to demand. If everybody demands more of the stock, the price will be high, for example. So the residual of the demand is exactly correlated, is going to tend to be correlated with the price. We need two instruments, one for the price, one for the aggregate elasticity. For the price, we actually follow Ralph and Moto's paper by just keeping track of how much money would go to our stock K if all investors invest in an equal weighted portfolio. For the aggregate elasticity, it's a little bit more subtle because we don't even observe it directly before we estimate the model. So we need to create what we call a model-based instrument, which is a counterfactual elasticity if everybody use the equal weights portfolios. This is an instrument that's based on model parameter. That means that we have to estimate the instrument and the model at the same time. This might seem a little bit non-standard, but it turns out that's completely econometrically okay to do that. Finally, we need to take this in the computer. So there are many fixed effects. We allow a lot of flexibility for investors, and you have to solve this equilibrium for elasticities at the same time. The short version is that if you don't do this carefully, your computer is going to blow up. So it's going to run for days and probably stop running after a while. But what we found out is there's something about the structure of this problem that you can somewhat invert. So you can separate out a relatively simple equilibrium problem that's only one dimension, and then quick regressions are quick to run. And so we have a code and we detail the algorithm in the paper to actually estimate this rich equilibrium model in about 5 minutes for a given quad. Let me now go to the actual results. So the first result I want to show you are our estimates of competition chi. So again, chi is how strongly do you respond to the elasticity of other investors in setting your elasticity. We have a separate estimate for each quarter because our identification comes entirely from the cross-section. So here I'm plotting a histogram of those estimates, and you can see that they're all relatively concentrated between 1 and 2.5. The average actually is 1.7 in our sample, and so that's what we're gonna use as our headline number. There's no trend in competition over time in the data. So it's not that there's less competition or more competition. Actually, it seems very stable around this value of 1.7. What that implies is that the same investor responds less to price movements for assets when there are more aggressive investors than for assets when there are less aggressive investors. And this is a substantial response. So if all other investors are more aggressive by 1, you lower your elasticity by 1.7. Yet this is very far from perfect competition. So this chi is much less than infinity. Of course, infinity is always far away from any number, but to be very concrete, in the simple calculation I did at the beginning, if you ask what would it take to have a 90% compensation of the direct effect of a rising passive, you need values of chi around 18, so an order of magnitude larger than what we find in the data. So we are very, very far from this idea that investors react and compensate every direct change. The model doesn't only give us this number. Actually, it gives us estimates of the elasticity for each and every stock. Here, the green dots are the one from our model. The red dots, because I want to compare a little bit, are from a model where we assume no competition at all. And here I'm plotting them as a function of market capitalization. And there's a few remarks I want to make about those estimates. The first one, and Ralph actually talked about this quite at length in his introduction, is that these elasticities are low. So they're about 0.3. Again, if you want to do in price impact, that's about 3. That's very much consistent with previous studies. So other structural model or kind of quasi-experimental evidence, that's much lower than this idea that, demand curve for stocks are flat. Actually, demand curve for stocks seem to be pretty downward sloping. There's a strong size effect, and it's telling us even stronger with endogenous elasticity than exogenous elasticity. And it's telling us that it's important to account for the fact that even the same investor trades differently for different stocks. The demand elasticity is not a fixed characteristic of the investor. It depends on which stock you trade. In particular, investors seem to be less willing to change their positions in large stocks that occupy a large share of their portfolio than smaller stocks that are a small fraction of their portfolio. Finally, and you can probably see this a little bit in this picture, and again, we quantify it in the paper, there's less cross-sectional variation in elasticity. So all stocks tend to be more similar once you have this endogenous elasticity. And the intuition is the following. Typically, let's say you see a very active investor show up and start trading a given stock. The aggregate trading for this stock would tend to become more aggressive, and this stock would, there would be stronger response of trading to prices for this stock. But what we see happens in the data is actually that all our other investors step back and trade less aggressively. And so that's going to compensate these changes in composition. And so it's not that every elasticity is the same. Again, we say that this competition is far from perfect, but it's going to tend to shrink the cross-sectional variation in elasticity. Now let me go to the biggest prediction we're after, which is what happens when we face a big rise in passive investing. So again, there are many ways you could measure passive investing. We like to do a model-based one, but you can also just look at raw data. So in particular, you can look at what mutual funds do. Here I'm plotting over the last 30 years, roughly what is the fraction of stocks held by active mutual funds, that the dashed blue line, and the fraction of stock held by passive or mutual funds or ETF. That's the solid black line. That's from the ICI fact book. So what you can see is that active funds have been stagnant or actually even slightly declining over the last few years, whereas passive funds that were pretty much inexistent at the beginning of the 90s have been growing steadily for the last 30 years, and now they occupy about 15% of the stock market. If we take this slightly more comprehensive view, definition of passive that's more model-based, we get a slightly larger number, but of the same order of magnitude. So we find that the fraction of active investors has gone down from about 78% to 58% in the stock market from 2000 to 2016. These are very large numbers. So, this expansion is actually as large as the growth of institutional ownership over the same time period. So the question is, let's say we fit this trend, and given the competitive structure of the market, what happens to elasticities in the market? Is the market becoming less elastic or more elastic? And so to do this, we're going to repeat the calculation I started this talk with, except that now we're going to entertain all the heterogeneity across investors and across stocks. So for each stock, the aggregate elasticity, you can show that it's the product of how many active investors we have, how active are those active investors, so what's the average elasticity, baseline elasticity, and a general equilibrium effect that comes from those competitive compensation. So here you can see our parameter chi showing you. And with this, you can simply ask, well, what happens if I exogenously change the active share? Of course, we know that the rise of passive investing is not purely exogenous, but that's a simple way to get started. Actually, you can microfund it in multiple ways, and this calculation will still be correct. So you can simply compute what's the elasticity, so what's the pass-through of a change in the fraction of active investor to aggregate elasticity, and you obtain this simple sufficient statistic. So it's 1/1 plus this competition parameter, 1.7, and the baseline level of active investor, because they're the only ones who respond to others, 65%. And what it gives us is, it gives us a pass-through of about 50%, 47.5% more precisely. What that implies that when we saw this 30% decrease in active investing, elasticities have dropped by half of that, so about 14.25%. That's a large decline. Now, we don't have to stop here. Okay, great. Thank you, Maya. We don't have to stop here. And we can, rather than just doing this counterfactual exercise, we can also just describe what actually happened in the data. Because we have a new estimation each quarter. Again, we haven't used at all the time series in our identification strategy, but we can just see how investors' trading behavior change over time. And so this is what I'm doing here. So I'm not trying to do this more causal counterfactual exercise, but asking what actually happened to elasticities. And what we see is, first, the solid black line is the average elasticity, aggregate elasticity across stocks. It is the change, sorry, in the aggregate elasticity. It has declined actually quite strongly, even more than by 15%, by about 30% over the sample. And the reason for that is that, yes, the fraction of active investor has decreased. That's the red line that's decreasing. But also the remaining active investor, even on their own elasticity has decreased as well. Even active investors are trading less actively than they used to. Of course, it's not a homogeneous decline because you get this competitive response. So because in part, even though on their own, the active investors are becoming less aggressive, you see that when they see others become passive, they respond by compensating and becoming more aggressive. That's this blue line, this very strong equilibrium response. So in net, if you are to just sum those two declines, you would get much more than that, but the competition lowers the total effect. To put numbers on that, the aggregate elasticity has decreased by about 35% over the length of our sample. It's roughly coming 50-50 from a decrease in how many active investors we have. So this rise of passive investing that has received lots of attention, but also from other investors becoming less aggressive based on their own characteristics. But again, half of that has been compensated by this competitive response. So again, you can see the glass half full or the glass half empty. Yes, there are strong competitive response, so that we see much less decline than we would see by assuming that all investors are just living their own life. But no, we are very far from a perfect competition and a perfect cancellation of changes in investor composition. So investor composition does matter quite a bit for aggregate demand for stocks. Let me just show you one last visualization of this result. This black line is the trend that actually happened. That's the last graph that I showed you. But we could ask, well, let's feed all those changes in individual investor characteristics. So let's feed the fact that we have more passive investors. Let's feed the fact that even the active investors want to trade less actively now. But now let's change this parameter chi as we compute the new equilibrium of elasticity. If you set chi to infinity, this perfect competition, you see virtually no change in elasticities in the market. Actually, the only reason you see a little bit is because the universe of stocks being traded is changing a little bit over time. So you just have a little bit of composition effect in stocks, but nothing would happen. In the opposite extreme, if you assume that there was no competition at all, you would see a much larger decline. You would see actually twice as large of a decline, and you would see that the stock market will become extremely inelastic. So competition did kind of like slow down this effect of much more inelastic market. Let me conclude. Sorry. First, I hope that I convince you that this notion of investor competition is a useful way and a useful formalization to start thinking about what are the equilibrium effects of changing investor behavior, such as the rise of passive investing, or also many other applications. And it's useful not only because it's simple, but also because we can embed it in actual equilibrium model and quantify it. And once we do that, I think we learn interesting things about the stock market. So we learn that the stock market is actually very far from this ideal that we often talk about of perfect competition, that investors compete and fix any problems in the market. And for example, what I showed you is that dampens the direct effect by about half, only 50%. What it means is that the rise of passive investing likely had a very large effect on the stock market, leading to about 15% more in elastic markets. There are many other places where this would be important. Ralph talked about a few of them. Tarun talks about a few of them. Jonathan already talked about a few of them. Again, some that I like are thinking about the more intermediation sector and how when we regulate various financial institutions, that's going to have an effect on how other investors trade. Another very interesting question is, as data become more available, if Citadel has much better computer and servers to trade, should that discourage us from trading quite as aggressively? And finally, in international finance, what if some large player like China stop buying treasuries? How is the rest of the market going to react? And so for this, we have to understand not only the demand of each investor, but how investors interact together in selling those demands. Thank you.
Thanks so much, Valentin. And Harrison, please go ahead and share your slides. You have 10 minutes.
Great. All right, thanks, Mariam. Can you hear me?
Yes.
Great. Can you see my slides?
Yes.
You want me to go full screen? Let me see.
Yes, that would be amazing.
Does that work?
Yes, excellent. Thank you.
Great. Hey, thanks a lot. Thanks a lot for the opportunity to discuss this very insightful paper. There's a lot in this paper, as Val's presentation demonstrated. I'm going to give a more focused take on what I think is kind of more the most central aspect of the paper. So what does this paper do? It seeks to estimate sort of a fund institutional investors stock demand elasticity using these 13F filings. Basically, you could do, of course, if you do that, you can do a bunch of things with it. One of the things I'll just focus on is to then get aggregate up to the aggregate demand elasticity at the stock level. Okay, and I think kind of the main contribution of the paper is that it generalizes the specification in the Koijin-Yogo paper. So in the Koijin-Yogo paper, they kind of derive as an approximation of a log utility demand with disagreement and short sales constraints, the specification that I'm putting my arrow over, right? So you're going to have as a dependent variable log of the weight of manager I on stock K, normalized by its outside assets. And then I'm going to abbreviate and focus on kind of the main term. It's going to basically depend on PK, which is the price or the market cap of asset K. The EIK is the latent demand term. And then kind of the key term is this elasticity term, which is how we write it as 1 minus epsilon 0I minus then the chi times the epsilon ag K, right? So let's just start. So again, in KY, chi is 0, okay? And so if you estimate that epsilon 0I is 0, that's pretty much a perfectly inelastic demand on the part of fund I for stock K, okay? So of course, I think what HHL would argue is that, I think if you just think of many of the theories that we have in finance, there should be some equilibrium feedback. Think about kind of a Grossman-Stiglitz model where there's going to be some equilibrium amount of information acquisition in the economy. So that's going to be captured by this chi greater than 0 parameter. And so, of course, a short way of summarizing this is that the estimates in Koijin-Yogo are potentially biased if depending on sort of a form of limited variable bias, although a very complicated form because epsilon ag K itself is an endogenous variable that's determined that depends on the equilibrium. So the paper, Val talked a lot about the reflection issues associated with that point. He talked less about the instruments, and I'll talk more about that. So they start with the KY instrument of PK, right? So you need an instrument because the concern, of course, is that EIK these two pieces are not orthogonal. And the instrument is going to be a popularity of stock K in fund manager mandates. I'll call that P hat K. Now you actually need two instruments to estimate their system. So they're going to kind of apply a similar idea to using these mandates to kind of get a second instrument for epsilon ag K, right? And I think the general result is that they find more inelastic demand curves than KY. Okay, so this is, I think, kind of the most interesting picture, and I'm going to spend a little time on the numbers and kind of give you a sense of the numbers. So basically, the red is the KY estimate, right? So this is now after all the computation, et cetera. This is going to be the epsilon. This is the elasticity at the aggregate level for stock K. Okay, and so what you see is that for the most part, when you account for this this potential feedback, you're going to get more inelastic demand. Okay. I don't know that obviously, like I was trying to think through it, I mean, it's not clear to me which way the bias would go in the beginning. I mean, obviously it's a pretty sophisticated model, but I think that the results are very provocative. I'll kind of point two things. First is there's a very strong size effect, basically in the HHL estimates, we're talking like these big stocks here, Apple, are essentially inelastic, right? Basically the epsilon is basically getting close to zero. There's going to be some standard errors and whatnot, but basically what this is saying is that, and here I want to connect, I think this is why this paper is so insightful, is that, if you start taking, so like in KY, of course, the view is that all the investors are essentially consumers, and we're treating the demand system much in the way you would think about treating goods prices, right? And of course, I think the model is, the paper is completely correct. We should definitely entertain a more general specification that allows also for the role of information, right? And of course, if you start taking that view, you can also think about other ways to test, right? In other words, like the epsilon now basically is a one-to-one mapping to information efficiency. Okay, so think about, so this is another kind of important equation in their paper, right? That you can have basically the price is equal to some fundamental value plus the inverse of the ag times basically x. X is going to be the exogenous kind of non-informational supply shocks, right? And so what the estimates imply is that large stocks are going to be less informationally efficient, right? Because these guys are essentially epsilon ag is close to zero. This thing basically blows up, right? So basically almost all movements, it's basically saying almost all the movements of Apple computers is going to be non-informational. Okay. And of course, I think that's probably counterintuitive to what you think are most of the tests that we've done on, if you kind of do it at the information efficiency level. And so let's think about a few different tests. So, there's an old literature on market microstructure, right? There's like, there's many papers I could kind of talk about, but like, for instance, there's a series of these Lowe-McKinley papers where, kind of in the heyday of testing kind of the random walk hypothesis, I think the perceived wisdom is typically big stocks are very informationally efficient, right? It's the small stocks that are not informationally efficient, okay? And then, I think there's a kind of different number of different reasons why you can kind of make that argument. They have more analysts, maybe their ARBs are a bit better, et cetera. There's also just, less frictions because of some scale effects associated with creating like shorting markets, and, so the list kind of goes on. And if you think about the more recent behavioral finance literature, I think the perceived wisdom is also there's much more anomalies in small stocks, right? Think about like the value effect is much larger in small stocks, right? There's more momentum in small stocks. There's also more post-earnings announcement drift in small stocks. Okay, so I think what this paper is pretty nice in connecting, I think is connecting, these estimates at the 13F filings of these elasticities aggregate up to the aggregate level is one way to do it. But it also, of course, the paper suggests there's a connection where you can kind of come back at least at the aggregate elasticity, right, using price information. Okay. So what I think is kind of driving this effect? So I mean, I think I don't believe that most of, I don't think that Apple is the least informationally efficient stock in the stock market, right? So I think that's a pretty counterintuitive result. So, sorry, that was the way. So what do I think is kind of happening? So, I mean, obviously, I think some of this has to do with the nature of the instrument. So let me see if I can kind of understand and walk you through the instrument. So the way I think the instrument works is, think about Apple, right? So Apple is in the S&P 500, it's in the Russell 1000, it's in like just basically a bunch of indices essentially. And think about GameStop. GameStop is, it's going to basically be in Russell value, right? It's not going to be in so many mandates. Okay, so my understanding of the instrument is that you can instrument basically then based on the heterogeneity, right? The variation that you're using is that different stocks are going to be, in some sense, be in more mandates than others. Okay, and I think the exclusion restriction is that as long as you think that the asset allocations, that is, these distribution across these mandates, that condition on the allocation, choices of stocks within those mandates are orthogonal, right, to these allocations of these mandates. Okay, and I mean, I think kind of it's probably, I guess it's kind of okay. I think in the sense that if you think about the small stocks, I think probably for the biggest stocks, certainly the largest stocks in the market, this is probably pretty difficult because I think U.S. stock market, for instance, it's like exceptionally concentrated, right? So if you think about, for instance, look at the concentration of the U.S. stock market. So this is the most recent year. Like 5 stocks basically account as 26% of the S&P 500, right? So, and I think even kind of over a very long period of time, it never really averages less than like 15 or so %. So I think kind of on the very top end of the market, right? When you think about basically how you think you can get, some type of an instrument for those type of stocks, one I think has to account for also this concentration. And if you sort of look at what's happening right now, if you just kind of Google, right, there's a lot of, because the FANGs are so big, there's a lot of discussions of ways of funds that you can buy to get FANG exposure, right? So like, you can invest in the BlackRock investment in technology mandate to basically get the FANGs. So I think that, basically, if this is an important enough effect, the instrument P-hat-K, of course, is going to end up being correlated with EIK, the latent demand, at least for kind of maybe the very high end of the market, the very largest stocks. And sort of in some of the stuff I've done with the Russell indexing, so I mean, obviously the Russell stuff is only the small stocks, right? The mid-cap stocks. It doesn't really extend to basically, the Russell 2 doesn't extend to the very high end. And there, I think, consistent with this paper, there was some increase in the impact over time with passive tracking, but I don't think the effects are nearly as big. I think, the impact of passive tracking, at least on the set of kind of these mid-cap stocks over time, even as passive indexing has kind of gone up over a lot in the last 20 years, we didn't see necessarily these huge effects. I mean, there was some effect consistent with this paper. So I think that kind of speaks to me that there's potential issues with, I think, kind of the instrument that at least kind of on the very high end. So I guess kind of, what I view as kind of the challenges, I think that obviously this is like, this paper is a hugely important paper. I think it completely makes a lot of sense to try to connect basically these 13F filings into, kind of all of the various theories of asset pricing we have. I think this paper, along with the KY paper, are kind of two of the important papers to kind of take this important step. But I would say that I think kind of, getting instruments for the large stocks is pretty important. I think it's obviously a lot easier to get the instruments for the mid-cap stocks. So I think that's kind of one set of challenges. And I think kind of the other set of challenges is that, it's not so obvious why you wouldn't want to also use information from the other tests of informational efficiency, right? Because, once you basically connect, in this paper, connect basically the elasticities at the fund level, right? To kind of this informational view, this information acquisition view, this competition view, some of that also emerges at the price level. So like, obviously the whether you do like a reversal test, whether you do a long horizon, short horizon variance test, it's going to basically pick up also information about this structural parameter. And so there might be kind of scope to, I think, link essentially these different types of tests. All right, so conclusion, I mean, it's obviously pretty easy to tell. It's a fantastic paper. There's a lot of great ideas here. And I think it opens up a lot of research pathways for the field. Let me stop there.
Okay, thanks so much, Harrison. So before asking questions, Val, if you would like to answer Harrison's comments.
Sure, yeah. First, thanks, Harrison, for those thoughts. Like, it's really very insightful and makes us think a little bit more, and we'll have to work more on this. I think one thing I'd say, though, is that, and that's the equation that you showed, like, what makes price informativeness is a combination of two things, in a way, is how elastic is the market or how inelastic is the market, and how much noise trading we have going on. And so it might be one way to reconcile those different filings is that it might just be that we have much less noise trading for large stock, even though investors are not adjusting their large stock position very much. Because actually, I agree, I'm a little bit puzzled, and we've been actually a little bit puzzled to find such low estimate of elasticity for large stock. But I also want to say that it's not so surprising, because if you think even a large fund that's close to an index fund, a big chunk of their portfolio will come from those large stock. And so adjusting your position by 1% of your total position in large stock is a huge change in your portfolio. Versus for small stocks, it's much easier to move your portfolio share, again, proportionally quite a bit. And so to me, I think it's not so surprising that the demand for those stocks is less elastic. The challenge, of course, is, well, why is there less noise trading in those stocks as well? And that is less clear, and our setup is a little bit less well suited to try to think about where the noise comes from and what are the dynamics of the noise. Just to wrap up on this, I think your idea of like zooming in on large stocks in particular, because they're so big and so important, and maybe try to find different instruments for those large stocks, I think is great, and we'll definitely get to it. I think, I mean, one nice thing of the demand system is that you can take all the stocks together and a very holistic estimation. And I think this is very valuable above and beyond standard kind of quasi-experimental evidence. But it feels like the large stocks don't quite fit completely into this, like, the same as every other stock. So I agree that it could be a good idea to separate them. And we will definitely think about that.